All right. So welcome everybody to Texas Multifamily Masters. Glad to have you guys on. For those of you that never been on, right, basically we're part of Multifamily Masters. It's a national group that we kind of help lead and run. Where basically we have a large amount of localized meetups throughout the country, right? All flying the same banners, all kind of helping network and build the bigger brand. We all get the benefits. So for this meetup, right, it's a Texas Multifamily Masters one. Rather, after COVID happened, rather than everybody continuing to do their own online thing, we figured it would be smart to combine forces and do a much bigger, better Texas one. And so, Ben and I run the Houston chapter. I'll let everybody introduce themselves here in a second. And our partners run the Dallas chapter. And once COVID passes, hopefully this summer, right, we can all start those in-person meetups, because I don't know about you all, but I really miss the in-person meetups. I miss getting to see people, hang out, and talk, right? It's just not the same virtually. And so, with that said, I am, I guess for those that don't know me, my name is Feras, right? I help run a company called Disrupt Equity, and we buy assets throughout Texas and Georgia. And on the screen is our my lovely business partner, Ben, who I will let introduce himself. And but before Ben introduces himself, for those that don't know, right, today we're basically doing a passive investor panel, right? The goal is really having people that have done passive investments, and really multiple passive investments, to kind of talk through some of the pros, some of the cons, some of the tips and tricks that you as an investor, or you as maybe someone new to the business, can get, right? And typically we'll do about 30 to 40 minutes of presentation, right? And by presentation, really, I mean the kind of the panel that I'll help moderate. And, please, people, if you have questions that throughout, go ahead and drop them. I'll open it up to Q&A at the end of the panel, right? And if there's something interesting, relevant, I might try to, mention it then and there. And then really after all that, right, we'll do what's called breakouts. And so for those of you that never visited before, right, breakouts is exactly what it sounds like. The fun of real estate, it's a people's business. It's a relationship business, right? It's people, it's making deals, getting to know people. And so we thought it was critical to really help foster that, even though we're virtual. So we do breakout sessions where we'll break up the entire audience into, groups of about 5 people or so, right? To let people kind of have about a 15-minute one-on-one with a smaller group, get to know something, right? Get to know somebody new, learn something new, and maybe build partnerships, right? That's how I met Ben, and that's how we met our partners on this call as well. And so with that said, Ben, I'll pass it over to you and let you kind of go ahead and introduce yourself.
Yeah, no, I appreciate it, man. So yeah, Ben Suttles, I'm the good-looking half of Disrupt Equity. Some might say the bald one too, right? No, but we started Disrupt Equity back in 2017. Been buying deals here in Texas as well as in Georgia. We like Atlanta. We're obviously, kind of got slowed down a little bit on the acquisition side this year, but ramping things up, putting things in place to really kind of maximize kind of on some deal flow that we're seeing in 2021. So we're excited about that. Also have property management in-house, excited to kind of, continue to build that business, both on managing our own deals as well as for friends and colleagues that we have in the business too on a third-party basis. So started off in IT, sales and business development. I always kind of tell people, I was selling gear back then, but, now I'm selling investment opportunities. Still the same shtick. Right. I was doing presentations. I was handing out business cards. I was networking. And so, for me, I eat this stuff up, and I love the networking component. I think Feras really brought up a good point. This is a relationship business. This stuff is important, even though we're doing it virtually. You don't get as much bang for, your time, but, people still need to, collaborate and get deals done. Nobody's going to be doing this, solo. Maybe you can get a deal or two across the finish line on your own, but most of the time people are doing this as a team sport. And even the passive investors, right? You guys need to be networking, finding out who's doing deals, right? Where are the sponsors? Who are the good sponsors, right? What did you like about this person or not like about that person? So the people that are just looking to be passive, don't expect yourself to be able to stumble into deals unless you're doing a fair bit of networking as well, and so, and Chat and obviously Mark and Oliver obviously know that, and that's the reason why they're on, right? So I'll go ahead and shut up, and I'll pass it over to John Monteiro, our partner out of Dallas. Frisco, my bad, Frisco.
Good evening, everyone. Thanks for joining us. John Monteiro, like Ben said, I'm based here in Frisco, Texas, just north of Dallas. I am the founder of Texas Multifamily Investor Network, 3,500 members, primarily on Facebook. So if you're not on the group, please come join us. A lot of good conversations articles, data that get posted on that Facebook group every day. I have, with my partners and investors, 3,800 doors under management. We just closed today 383 units in Mesquite, Texas, $38 million deal. So we're happy about that acquisition, and primarily focus on the primary markets in Texas only, DFW, San Antonio, as well as Houston. I'll hand it over to Anton.
All right, thanks, John.
Thanks, John. Hi, everyone. Anton Mattli, co-founder and CEO of Peak Financing. We arrange financing for commercial real estate all across the country with a strong focus on multifamily properties. That strange accent is from Switzerland. So even though I've been living in Dallas, Texas now for 15 years, pretty close to John. We live in the same city, just on the opposite side. And I'm also a co-chapter leader of MFM for the Dallas chapter. And naturally, John and I and Ronnie, we all looking forward to live meetups again. That we had a number of live meetups pre-COVID that were absolutely great, and we can't wait to restart those.
Hopefully, we don't have to wait until the summer. I don't know. We'll see. Right?
Yes.
Yeah,
so let's let them crank out the vaccine.
let's do it. Let's do it.
Absolutely. And Anton's going to get his Swiss friends to help with that, right? So.
Yeah, actually, Switzerland is ahead of the curve. They have 8.6 million population, and they ordered 7.5 million in vaccinations that they're
Switzerland's
getting.
always ahead of the curve, right, Anton? So, leave it at that. And you should check out their knives. They got really nice knives. So and watches. So with that said, I think that's everybody on the leadership team. So
Well, no, you got Ronnie and you got Neil. Hold on real quick.
I don't know why Ronnie went.
Yeah,
Sorry.
Ronnie, you go first, and then pass it off to Neil.
Awesome. Thanks everyone for joining the meetup. Appreciate y'all's time. Ronnie Phillip with Kingly Acquisitions, based in Dallas, Texas. We currently own in San Antonio and Atlanta. We love the Sun Belt region, and that's what we focus on primarily. B and C class, moving more into the Class A space. So I'll pass it off to Neil.
Hey everyone, Neil Bertrand here. I feel like I say this every month, right? 22-year multifamily veteran, executive positions and asset management operations acquisitions. Hopefully, Anton, I can go to Switzerland in April like I plan to. In a deal with Ben and Feras in San Antonio, and have shovels aimed at the ground in Santa Fe for Q1 next year, Class A 223 unit new development. Hopefully 2021 will be better than 2020.
God willing, right?
All right. Now that's everybody. I don't know why. So with that said, right, I know everybody's not here for us, right? I know you guys might like us, but we're really here for the panel. Right. And so with that said, we really reached out kind of into our network, right, of past investors that we know or have invested with someone on the call, and figured basically have them hop on and kind of share a little bit more about their lens and their perspective. Right. So the goal is really, to ask them things that I think passive investors want to know. Right. What do you look for? How do you find deals? Right. What do you evaluate in a deal? And kind of really talk through those. And so with that said, we have 3 panelists, and I want to go ahead and let each of them introduce themselves for our call today. And so with that said, Chat, do you want to go first? She's all the way in California, so, it might take a
Chat.
The internet signal's a little far, so. We lose Chat? All right. Well, Mark, I think you just signed yourself up. You want to go next, Mark?
Yeah, I can guys see she's not, she's muted herself. So I'm out in California as well. Chat and I are only about a couple hours away from each other. There she goes. Go ahead, Chat. I see you're unmuted.
All right, I was just yakking. I didn't know I was muted. Hello everyone. My name is Chat Sarmiento-Steinwald. I'm from Los Angeles, and it's an honor to be here. And I am here to talk about me being a passive investor. And I have been a passive investor since almost 3 years now, and it's been great. I also have scaled up into a GP and looking for a JV opportunity, GP opportunity. But I'm here to talk about passive investing. So.
All right. Thank you, Chat.
All right.
Let's see, Mark, you want to go next?
I take turn. Yeah, so Chat and I are about an hour and a half actually from each other. We met at a multifamily meetup and then also at one of Rod Cleef's events. Yeah, I'm in 4 different properties passively right now, 2 with Kingly Acquisitions and Disrupt, and also a couple with one of the other very well-known guys out there, and looking forward to getting in more of an active role as well. I know Feras or Ben, someone said to me recently that I was passive active, so a little bit of being far more active than in a passive role. I don't like to just sit on my hands and watch. I want to be involved. So I've seen all the properties I've been involved in and I've invested in. And I visited with Feras and Ben and with Ronnie over at, and with Neil for that matter. I met Neil too out at several of the properties out in the Atlanta market, and I look forward to doing some more of it.
Awesome. Thank you, Mark. And last but not least, Oliver, how are you doing? You want to go ahead and kind of maybe go ahead and introduce yourself?
Sure. Yeah. So my name is Oliver Werther. I started investing in single family homes 20 years ago back in Germany. And after I got my engineering degrees, moved to the US in 1998. And then I'm out of single family investments right now. But 4 or 5 years ago, I started looking into multifamily investments as a passive investor. And that's what I'm doing right now. And so we have invested in 15 different deals and apartments across 5 different states, mainly in Texas, Florida, and Colorado. And yes, I mean, I like to use my engineering background to go through financial statements in quite a bit of detail and try to understand as much as I possibly can about the investments.
Yeah, and then to add, I think Oliver has one of the more unique perspectives, and I really like it because again, just having that numbers engineering approach, I think it's a good way to do it. So definitely, I do want to dive into that later because I think it's something people will, I think, get a lot of value out of. And so maybe to kick things off, right, I just wanted to maybe high level, how did each of you guys just get introduced to the concept of multifamily investing? Right, that's maybe the first question, and we'll keep it brief because I know there's going to be a lot more questions coming up later as well. Oliver, you want to go first? We'll go.
Sure.
Around.
Yeah, so it was, I think it was 4 years ago when a friend of mine introduced me to the concept of investing in apartments and multifamily investments. He invested in it for 1.5 years at the time, and he talked to me about the concept and the returns he was getting. And at the time, I was actually somewhat skeptical about the returns he was stating that he was receiving on his investments. But yeah, the executive summary is he connected me with an asset manager and a deal sponsor, and that asset manager was kind enough to give me like 45 minutes or 60 minutes of his time. And we had a personal video chat, a phone call, and he introduced me to the concept, walked me through the plan and how it works. And that's how I got started 4 years ago.
All right, perfect. And Mark, you want to go next as well?
All right, sure. So introduced into that probably was listening to Grant Cardone, everyone's favorite guy to love or hate, and listening to him and what he was doing. And my son requested that I listen to him. He said, "Bud, you got to listen to this guy." And through him getting more familiar with it, actually Ronnie and my son know each other and were interviewed on each other's podcasts and whatnot. And so through Ronnie, and through Kingly Acquisition, I got another comfort level with getting to invest in the multifamily. I was comfortable anyway, to be honest. I've been a broker for 20 years. Real estate's kind of what I do. So I was probably a little bit more open and a little bit more willing to jump in on something, even though I didn't know all the details that maybe I should have been. Yeah, so that's the intro. Through Ronnie, with it happened. I happened to be in Texas, and while Ronnie interviewed my son for his podcast, and we just got to know each other through there. And then, of course, Ronnie introduced me to Ben and Feras, and the rest is history at this point.
Awesome, thank you. And last but not least, Chat.
Hi, mine is by accident, really, out of need. My husband passed in a sudden manner, so therefore I needed to look for something where I could have a financial health in my retirement and, preserve what I have. So what I did was initially I rented my house in where I live because emotionally I could not, I could not live in it anymore. So that was great. But then, for obvious reasons, the landlord tenancy laws here in Los Angeles was just so bad that I had to look for something else. So I was, I think I found this infomercial.
Hey, everybody, hold on. Everybody,
Here,
if you
I'll go
could,
ahead
you can mute. Let's
All right, we're good to
mute
go.
everybody. All right, there we go. Sorry about that, everybody.
Okay,
There you go.
are we good?
Keep going.
So I found this infomercial for single family homes. Fast forward, it didn't work for me, lost money on that one. But because of that, I found podcasts and I found Rodcliffe's podcast. And I just so happened to, he just so happened to be in here within 3 days at that time of my listening of that podcast. So I called for a ticket. I had it, and 3 days later, I was there. And to make the story short, my life has changed since then. I became totally immersed in multifamily investing and loving it.
All right, thank you, Chat. And so for all three of you, right, I'm going to ask you 3 questions. So I'm going to tell you guys the questions up front so you can kind of give some thoughts in it, right? Really, the questions are, how do you evaluate a deal, right? What do you not like about an opportunity, right? And then kind of what are some of the favorite markets you've seen? So those are 3 questions I'm going to ask, and I'm going to let you guys basically just go answer all 3 of them in one go. And so with that said, let's say I'm going to change it up a little bit. Mark, you want to go next?
Unmute myself, I guess, first step, right? So you said how to evaluate a deal, how I evaluate a deal.
Yeah, so I'll ask, okay,
not like.
I'll go ahead and ask him again, right? So I'll ask him to you, so one at a time. So how do you evaluate a deal, right? That's maybe the
honestly, first I go the other direction a little bit. I'm looking at the operator first, or the deal sponsor. Is it someone I know, like, and trust? And for me personally, I want someone that I can be more involved. For example, like investing with Grant Cardone. I know I'm not going to be able to call Grant and talk to him on the phone, or even really go visit a property with him or anything like that. So I wanted to be more active. So I had to look for someone else, another company to do that with. But evaluating the deal, the primary thing for me was just not California. As we all know, California's rules for evictions, to say they're landlord friendly or landlord tenant friendly would be a vast understatement. The tenant can pretty much rule as though they own the property, and you have very little say in that. So Texas or many other states that are pro landlord, or at least you can get someone out if they're not paying within a reasonable time period. Those are the states I'm going to look at. Georgia is in that group. Even Arizona and Nevada, you can get people out fairly quickly if they're not paying. And just not California was kind of the deal evaluation for me. And then what are the splits? And I look at the splits and stuff too, as far as cap rate and everything. All right, what the pref might be.
All right, and then maybe here. So instead of doing all 3 in one go, I'll do a round robin. So Oliver, do you want to go next as well, around just kind of, what do you look for in a deal, right? How do you evaluate a deal? And Oliver, I'm going to have some other specific questions for you later, right? So we can kind of dig into some of the nuts and bolts that I know that you definitely kind of like to decipher. But maybe just generally, you want to kind of go on through it?
Sure. Yeah, I mean, in general, I would like to establish a relationship with the deal sponsor. I need to know the person who's running the deal. So it's usually important to me to just get to know the person who is managing the apartments. That usually means that I would like to see, or that I ask if it is a new deal sponsor. I will usually ask him if he can provide to me like a presentation he did on an existing deal like a year ago. And then for the same deal, send me the current T12 and the last 3 monthly communications he had with his investors. And if that's okay with him, I ask him whether we can chat on the phone for 30 or 40 minutes a week later after I had a chance to go through these data or information. And so if the relationship with the deal sponsor is worked out, what am I looking for? In general, I prefer to receive a preferred returns as a passive investor compared to like a straight split scenario.
So Oliver, before you continue, for people that are new, do you want to explain to them what a preferred return is?
Yeah, maybe I will get to that in a second. I have seen that a straight split return structure is very often used, and it basically means that there's a fixed split relationship between what the deal sponsor receives in compensation and what the passive investors receives in a compensation. And it's very often a 20-80 or 75-25 or 85-15 split. And this split is independent of the performance of the assets. So even if it doesn't perform, the ratio remains constant. And a preferred return is basically a scenario where, I mean, they can be structured in many different ways as well, but one typical scenario is where the passive investor gets a preferential treatment up to a certain point. So maybe the asset manager is projecting or promising a 7% return first. And in that scenario, all the returns that are being generated will go to the passive investor first. And then after a certain percentage has been achieved, the conditions change a little bit. So let's assume the 7% have been achieved, and then all the profits that are being generated or the returns that can be returned to the investors, they will be split in a different ratio, maybe 50-50 after or 40-60. So these are the 2 fundamental differences.
Yeah, and maybe just to say it a little differently, right, is that as a passive investor, right, you get paid first, right, up to an annualized return, right, and it's annualized before the sponsorship can start to take any of those new profits. That's kind of the long story short. So,
yes.
And maybe on that same note, while we're on it, which of the 2 models do you prefer and why?
Well, I prefer the preferred return because it provides an incentive for the asset manager to move the asset forward to generate the returns. And if you look at the ratios, the ownership ratios of a passive investor compared to an asset manager, very often the deals are structured in a way where a passive investor will end up owning between 0.5 and 1.5% of the equity. And if you have a straight split scenario, the asset manager owns maybe, let's say, 15 or 20%. So if an investment works out well, then it really doesn't matter. It doesn't really matter that much. You get the promised returns. But if the investment doesn't work out that well, and let's assume you can only pay the investor 1 or 2% for whatever reason, this means that you get almost no returns as a passive investor. But the asset manager, since he owns 20% of the equity, it is still a sizable income for him. And so I think the incentives are set up differently if a preferred return is offered to the investors. And then if the preferred return is met at 7 or 8%, I personally don't mind at all that the asset manager gets a higher split, like 50-50 after the preferred return has been hit. And that provides a huge advantage or incentive for the asset manager, because if he has really a home run scenario, he can make a ton of money if he exceeds the preferred return.
Yep, absolutely. Perfect. All right. And then maybe any other specific thing you want to call it that you really kind of look for in a deal besides the splits?
Yeah, well, I do the spreadsheet analysis, but maybe just a few points. If an agency loan is used, I would prefer to see a step down prepayment penalty versus yield maintenance. So you have better chances of selling the property early. And
for those of you that are new, that's an important point, right? Even as an operator, you start to learn, like, we have deals that we could exit really fantastic returns right now, but you're stuck because of a yield maintenance and you have to ride it out longer, right? And so I think it's a point in most very few passive investors actually ask that question, right? Is it yield maintenance, is a step down? So I think it's a very good call out.
Yeah, and then I would like to see a limited or a lower leverage if possible, 60 to 65%. And I would like to see that the asset manager has done a break-even analysis. So what happens if occupancy or economic vacancy reaches a certain level? I mean, for how long can you actually cash flow the property?
All right, perfect. Thank you very much, Oliver. So we'll come back to you kind of more on that. And Chat, last but not least, similarly, right? What do you look for in a deal?
First and foremost, just like I echoed the gentleman here before me, because the first thing that I look at in a deal is I have to make sure that the syndicators and the operators are the ones that I feel comfortable. I have to vet them first. I have to make sure that I'm aligned with them in values, principles, business goals, and their track records, and their the terms and the business plans, and are they skilled enough to execute business plans? Are they able to sustain the things that they have said they promised in the sale of the deal, and so that's, to me, is very important. And how I vet these people is I go out and call each and every one that have invested with them, and mind you, they talk. If these syndicators are really good, they will not stop talking about them, about how great their returns are, about how great their deals are. But if they're bad, they will not refuse to say also the same thing. So that I found that it's very helpful. I also try to stay in the areas that I like to invest, like the path of growth, where there's economic progress and all the great factors necessary. So I do that also, and I do analyze the deal myself in a very quiet manner. And also I try to stay with my asset class. I try to stay with C+, B+. Try to stay away from A at this point. And I don't know why. If you want me to explain why, I could. But...
Actually, well, go ahead and explain.
Oh, yeah.
Okay, I chose the B, C+ to B because I feel that in that class asset, especially during economic downturns and pandemic like this, I feel that the trend for people that are in the B class, it's more, in the A class, it's more affordable for them to move to B class, or in other words, the B and C+ classes will be more sustainable for these tenants. Whereas obviously for the C- and D class, I stay away for very obvious reason, the maintenance and operating expenses, the moving out of tenants. So I stay away from that. And so that, for that reason, that's the only reason. So I can kind of feel that, and I can kind of attest that now with this pandemic going on. Yes, I have very short time experience in this one, but I'm very happy with the asset classes that and the investments that I have chosen so far, knock on wood. I've still been getting my projected, if not surpassing the projected income of my investments. So I'm still very happy with that. And I researched from other classes, and a lot of my other friends with who have invested in like A class, they're somewhat in trouble. So
All right.
That's
Thank
what.
you very much. So then maybe to change the table. So let's go to the opposite of that, right? What do you not like in an opportunity? And let's see. So, Mark, let's go with you next.
All
Maybe
right.
kick
What
off.
what I don't want, what I want to make sure of is I'm going to ask is if the deal sponsor has ever had a cash call before. So they went out and they invested in a property, and for some reason they didn't either foresee repairs they were much higher than they thought, or they got surprised there, or they just didn't raise enough money in the very beginning to think it through for whatever reason, and they're having a cash call. They have to go to all their investors and ask for more money. If that's happened to them once, if I could get a very, very good explanation, I might be open to it, still investing with them. But if it's happened twice, there's no chance I'm investing with them. Even with the market and the craziness that's going on right now with COVID, as long as you were being careful and making sure your property cash flowed properly, you really shouldn't have that kind of a problem. I'm also going to look for probably a little bit of high costs, like what are their management fees? What are they charging the group to manage the property, the asset management fees, and the acquisition fees? Are they out of the ordinary as far as, how high are those fees? And then the last thing would be if those fees are too high, and then also if I felt the split was unreasonable, I might avoid that as well, depending on the deal. But I'm in a couple deals that are split. 3 of my 4 have a preferred return, and one of them is the 80-20 split that Oliver was talking about. So that one's a little bit new for me. That's relatively new. I haven't really started getting payout on that yet, so I'm still unsure if I like that one or not yet. I tend to like, I think, the preferred return model as well. But so I was a little bit reluctant on that at first, and I don't know yet if I'm going to like it or not.
Got it. So perfect. Sounds like, your answer basically is, kind of aggressive splits, right? To put it nicely, right?
Mhm.
Cash calls, and there was a third one. I kind of lost track of what.
Just the maintenance fees and acquisition fees. If someone's getting double or triple what other people are getting, there's probably a reason for that.
All righty, perfect. Thank you very much. And Oliver, you want to go next? And so the question is, again, just to repeat it, right? What are things you do not like in a given opportunity?
Yeah, so from a deal sponsor point of view, I really need to make sure that I will have access to monthly financial statements, that I get monthly updates on what's going on. And but then a few other general things. If the assumption for the tenant income ratio of his income relative to the rent is too low, very often I hear asset managers saying that a ratio of 2.5 is sufficient. That makes me a little nervous. So I would prefer to see that at higher ratios of 3. Then also, as was already said, if excessive fee structures are in place, that would be a warning sign. In terms of the parameters of the deal, if very high leverage was used, if it is just maximizing the loan amounts to the absolute maximum possible, that would raise a red flag. And then by analyzing previous deals, I have seen that some deals fell apart when the property taxes were underwritten at less than 100% of purchasing price. And that is especially important in Texas, and it depends on the state you're investing in. And I know how the games are sometimes played, and you can, file lawsuits and do all kinds of things. But I personally have concluded that I want to see that the underwriting is done assuming property taxes based on 100% of the purchasing price. And if you can strike a deal with the county that gets you to 80%, great, then you have an additional 20% of margin on it. But I don't want to be surprised that the property taxes are a lot higher in year 2 or 3 than what was originally assumed. And these are some of the things that are important to me.
Thank you. And last but not least, Chat, same question.
Yeah, I think I echo the gentleman here, but I just like them, I prefer to invest in an investment with preferred returns. I just feel comfortable. It's a personal choice. I have very low risk tolerance at my age and at my situation. So to me, preferred returns makes me feel more comfortable. I also like to look at the loans if it's a non-recourse loan. That just makes me feel better about it. And also, I just like the gentleman, I also look at the fees. If it's excessive, then I will pass. And I think that's about it.
All right.
On top of my head.
And then I guess the turnaround to the last question, right, that I had for all of you. And then I'm going to open up for Q&A. So I'm sure people have questions, so we'll let them kind of ask it. We'll ask it. But, it's really kind of given all the deals that you've seen, all the deals that you've invested in, what's your favorite market and what things about that market is it that you like? So Chad, I'm going to ask you that question first, just to kind of be fair to Mark and Oliver.
Yeah. Right now, my favorite market, to be honest with you, is Texas, Dallas and Houston. And there's a big, I like Phoenix and Tucson, Arizona as well, and definitely Atlanta. I'm heavily invested in Atlanta as well. So those are the markets that nothing in California for sure.
Also, but besides the fact that they're landlord friendly, right? What else are they, what else attracts you to them though?
Oh, the path of growth, economic growth, landlord tenancy, and those are the major factors for sure.
Okay.
I mean,
and then let's see. So Oliver, same question for you.
Yes, so we have invested in Colorado, Florida, Texas, Georgia, and Connecticut, I think. The last two are too new to really pass any judgment yet. In the past, I liked Texas a lot. But what we are seeing right now, it becomes more and more difficult to find really deals that work out just fine from a financial point of view. So I think Texas going forward for us is getting more difficult. Although we have invested quite a bit in Texas. In Colorado, what I really like is they have extremely low property taxes. So that's advantageous. And we have two investments in Colorado that perform really nicely. And our Florida investments also perform nicely as well at the moment. So.
All right, perfect. And last but not least, Mark.
All right. For me, the market area is almost not even that important. What I'm going to look at is the deal itself first. And as long as the market itself is not losing population, I'm going to go on and check economic growth, job growth, and also population growth. Like I was offered a deal recently that in 20 years, the population has gone down 8%. So it was it appeared to be a crazy good deal. It's like 17 or 18,000 a door, I think, something very, very low. But in 20 years, they've managed to lose almost double-digit population, and they had a very low income overall as well. And it just sounded like to me to be a mess. I could have bought that by myself even, and rather than syndicate. And it scared me enough to think that if people are just moving away, there's no new opportunity, there's no new growth, there's no new jobs. It's just a dead end. So I really don't honestly care all that much what state it's in, as long as the population, all the other things match up. I think I've heard, Detroit has had population loss 40 straight years. So yeah, probably not going to go to Detroit and invest there because it's cheap, but it's also just lose people every day.
Perfect. All right, so with that said, I'm going to open up for questions. So if people have questions to ask them, feel free to go ahead and drop them in. I'll answer, I'll ask the questions and kind of have them answer it. All right, we'll do it for about another 10 minutes, and then we're going to pause and then switch it to breakout rooms, right? And a reminder, breakout rooms will basically break the entire audience up into about groups of, 5, 6, and let people ask questions and get to really have a little bit more of a private conversation, get to know somebody, right? So with that said, is there any questions?
Yeah, I've got one. So to the panel, what has influenced your decision to be passive investors instead of taking a more active approach or moving over to the GP side, right?
I can answer a little bit real quick on that, Neil. The first was for me, I'm busy. I work 50 hours a week normally. I don't want to work any more than I do now. So I needed something passive for the moment. I sold all my residential real estate. I had 15 houses and some multifamily and some other stuff. I sold all that. So I had to put the money somewhere and make an income on it, but also still work my job. So selling real estate. So I wanted to make sure that my focus wasn't too split up. Although next year my goal is to be almost exclusively multifamily, but right now it just made sense to make a good rate of return, not put that money in the stock market, as although would have done great at the moment. It also it doesn't offer the stability that multifamily does. So I went that direction.
All righty.
Okay, so for me, it is basically, I mean, I still enjoy the engineering work I'm heavily involved in, but also having invested in 15 deals and studying all the financial statements in detail, I have concluded that it involves a huge amount of management in terms of managing the property management company. And so if things go wrong, you as the asset manager, if you take your job seriously, you have to spend a huge amount of time managing the property management, getting involved into the details. And for the time being, that's just not something I want to do at the moment. I prefer to be a passive investor and invest my time in selecting appropriate deals and hopefully maximize the passive income I can generate.
Yeah, absolutely. And I think, you hit it on the head. I mean, managing the property manager is a full-time job, and that's where you get burned, honestly, right? If it's not managed well. And, we've since moved management in-house, and that's been a blessing, because it is very hard to manage these third-party managers, right? There's a lot of, it's hard to really dangle the carrot and the stick effectively sometimes, right? So
yeah, I mean, if you have a deal that works well, I mean, then you maybe get away with a 1 hour conference call a week with your property management company, and it's a smooth sailing from here. But if the deal doesn't go well, I mean, you have a full-time job on your hand just for one property, and you do that with multiple properties. It's a huge effort.
I totally agree. All right. So let's see. So we had a question came in as a direct message to me, so I won't say who asked it, but basically the question is, what are average fee percentages? What is excessive? And then what is more than average fee structure or too many fees? Anyone want to answer that one?
I used to have all that written down, but I don't have them anymore. I'm sure Oliver knows those.
Well, I mean, what I like, I mean, very often what I see happening is that an asset manager says, or a deal sponsor says he has a skin in the game. He has invested, $50,000 or $100,000 of his own money. But what is not clearly spelled out in a very transparent way is that he charges an acquisition fee of $150,000 or $200,000. So what I usually prefer to see is that the asset manager has skin in the game, in a sense that after he collected the acquisition fee, that he has still some of his own money invested in it. And so that is one thing. Then you have to watch out for or look for the management fees that are being charged, or the asset management fees, and then fees on the front end acquisition fee and fees on the back end when the property sells. And so just to be absolutely clear, I think it's a very, very difficult job to find good assets and to manage them. So I think it's absolutely necessary that the asset manager charges an asset management fee. It's also fair that he charges an acquisition fee, because sometimes the asset managers have to look for 6, 9, 12 months to identify a property. It's a huge amount of time that is involved. So it's only fair to charge an acquisition fee, but I just want to see it, balanced in a certain way. I don't just want to see excessive fees.
I think it tends to be 1.5% to 2% is pretty common for asset management, and not too far from that for acquisition as well.
Absolutely. I think those are
I've seen it at 3 and 3.5.
That's more of what the average is, right?
Yeah, sometimes when a deal gets really large, so when you talk about, 25, $30 million deals, if you keep the acquisition fee at 2%, at some point it gets really large really quickly. But I would agree, 1.5% is a typical number for deals less than 20 million of size or so.
So then, any more questions? If anyone has questions, feel free to ask them or send them directly to me if you don't want to publicly ask them, I guess. Okay, here's a question. What are the advantages for sponsors owning the property management company that is being used to manage the multifamily asset? Would it be fair to sponsor, would it be fair for the sponsor to take a smaller asset management fee since they also own the property management company? I have my thoughts on that one, but I'll let you guys answer that
As
one.
I say, that's Ronnie and you and Ben.
Yeah, I got a lot to say about that.
All right, if no one has anyone, Oliver, Mark, anyone, I'll answer that at least.
No.
Well,
I would say the answer is no. You should not take a lesser fee, but beyond that, you can explain the reasons.
Yeah, so I'll say this. I mean, property management is not a profitable business, right? Really, the point of bringing, to be honest, I think we probably lose money on our property management right now, right? I mean, it's in that range. It's really more of a means to get better quality operations, right? That's the reason I think most guys bring it in. It's not a profit center, right? It's more about control and getting the right systems, right processes in place. Asset management, its own role, right? We have a full-time asset manager, right? That is its own role, own independent. And really, we even though it's in-house, we treat it as a separate company. We tell the asset manager, your bar is here. The management company needs to meet this bar, not go lower, right? Just because it's all in-house. And so they are very much two distinct roles. And, again, management is really not a profit center at all. So that's my thoughts on that one. All right, so I'm gonna go ahead and keep going. So there's another question that came in. Well, actually a couple questions. So what value add do you look for? That's a good question.
There's a lot of that value add. Chat was talking about value add before versus buying something that's A-class or something, but there could be any number of things. It could be a property that's being run poorly, but the property itself is physically okay. But that, some owners, they've owned it 20 or 15 years or something, and they're just not keeping up with the modern times and keeping up the rents. So you might just be able to go in and paint the outside of the building and raise rents. Or you might have a situation where you can bill back for utilities, and that might be a value add, or just improving the interior of the units. It really is instant. They're all the same. I mean, I've flipped many houses. I've been involved in probably, 100 or 150 house flips with either myself or my clients, and with rentals and properties and stuff as well. It's the same thing. You're going in, fixing it up, painting it, carpeting it, new flooring, modern flooring, and trying to get more rent for it. And ultimately, as long as you can get the rent up bump that you're looking for, to some degree, do as little as you can to get that rent bump. But also, for me personally, I tend to do a little bit more than I'm supposed to do to get that rent bump. So, because I like to have some pride in ownership, and I want the property to be to look much better than it did than when I first bought it. So I know the idea is to go in and fix the outside first, and while you're fixing the outside, you start rehabbing the interior units. But value add can mean a lot of different things. It just kind of depends on the property itself to me.
All right, perfect.
There's one of the things that I look for, or in some of the best deals that I have seen, the previous owner has owned the property for 15 or 20 years or so, didn't pay much attention to what was going on in the market, and the market or the rents he was charging were way below market rent. Yeah. And depending on where your property is located, you can do very simple improvements and raise the quality of the property and add quite a bit of value to it. But it's difficult to find some of these investments where the seller has already owned the property for many years, but that has been sometimes very profitable in the past.
All right.
That is very true. It's also you find that some of these operators, they don't market their units right, so that they're not getting the right rents. So therefore, you know, that's also where you can take advantage of that, you know, to increase your rents, and, you know, so that's where the value add also, aside from what the gentleman had mentioned already.
Perfect. Let's see. So another question that came in. Where'd it go? Sorry. What is the minimum investment in a deal? That's deal dependent. I'd say you see them from 50 to 150 on average, right? $1,000. Another question is, what is a good amount to expect from the syndicators to ensure their skin is in the game? Should it be a minimum 100,000? Sometimes that is less than the equity being raised. Is it reasonable to look at it from a percent perspective, like 2 to 5%?
I just think at least what they're asking for me. So if the minimum is 100,000 and it's coming from me, I'm going to want to see at least that 100,000 in there as a minimum for them. So, you know, just as a quick rule of thumb for me anyway.
Yeah, I would agree with that rule and just add that I would like to see that after they collected the acquisition fee.
Right.
Same thing here. Yeah, I'd like to see the skin in the game.
Hey, let's keep going. I'll do maybe one more question, then we'll call it a wrap. And then we'll move out to breakout. So besides diversification, what makes passive investing in multifamily better than investing in turnkey single family rentals? Maybe Mark, you've done turnkey single family rentals or no?
I have not, but I've heard some things. What you're basically with a turnkey a turnkey single family home, you're buying a house that essentially has been flipped by another investor. So you're buying it to me, you're buying it at its peak already repaired price, whatever that price is. So they're generally going to be in lower end areas, entry level neighborhoods and stuff where they're very affordable. You know, right now in the market we're in, you might buy a single family home for 90 or 110 even, something like that, that's already been rehabbed. But the reason it's already been rehabbed at that, because they've spent $30,000 or $40,000 already fixing it up. So you're paying the rehab price, the retail price on it. You're not buying the value add that Chad was talking about earlier. You're buying something that's already been value added. So there's no upside potential with that. You're really purely just buying income. So if you want just income and you want to buy a couple of houses, it's not a bad way to go. But if you want to scale and get more inventory and take advantage of the value add opportunity where you can increase the price and the value of something, that's not going to happen in a turnkey.
All right, good answer. Anyone else have to add to that? Otherwise, I will shift things to breakouts. All right, going once, going twice. All right, everybody. So for those of you that have never been on this call before, right, we're basically going to break the audience up into breakouts. So again, to repeat, it'll be about groups of 5 people, right? And, you know, have a conversation with the people, get to know where they are, what they're doing, what are they looking for, right? Real estate is a relationships business, right? It's all about who you know and kind of figuring out how to grow together. And so please use this as an opportunity. I think people love this as a big value add. And so, you know, we're something we love doing. So with that said, I am going to go ahead and break us out. So see you guys in a little bit. We'll do it for about 15 minutes, by the way. And let's make it happen. All right, well, welcome back, everybody. So that's really the end of our meetup. So, you know, I guess with that said, I'll go ahead and call it a wrap, and I'll leave this room open. So if people want to hop on, just maybe network in this larger room, you know, we can kind of leave it open, right? That'll be the last one for this year. All right, we will start back up in January, and you continue to do one a month with the goal of hopefully coming, you know, summertime, we're all doing these in person. But with that said, I just want to thank our speakers. You know, thank you, Mark. Thank you, Oliver. Thank you, Chat. Definitely appreciate you guys taking some time out on a late Wednesday evening. So definitely appreciate that. I'm sure the audience got a lot of value. You know, I like to see kind of from the lens of, you know, really what the passive investor is, right? And, you know, I got value out of it. I'm sure the audience did. So thank you all very much. With that said,
a quick question, Feras.
Thank you, Feras.
How's the MFIN going for the new?
Yeah, no, I'm glad you brought that up, Mark. Thank you. Yeah, I'm going to shamelessly plug this. Everybody knows that I don't like to sell stuff, but we are holding a conference in person, COVID safe, right? February 27th here in Houston, Texas. You can check us out, mfinvestornetwork.com. It's a one-day event. We do a lot of networking. We get a lot of great, speakers out there. So you learn a lot and you get to meet a lot of great people. So use the coupon code DISRUPT for $100 off. So check us out there. We're putting a line in the sand. We're going to try to see if we can make it happen, right?
Yeah,
God willing,
we had to cancel.
We've had to cancel the last two.
We had to cancel the last two, but the last one we did was in Houston. So we're back in our backyard. Last one we had 400 people. We had the mayor of Houston out, so we're trying to figure out, the lineup and kind of dot the i's, cross the t's. But people
This is a great place to have an event.
We're trying to, right?
Yeah, it's great.
Natalie knows how awesome Houston is. But yeah, you guys can get some barbecue when you're in town. But check us out if you would, and do that thing that Jeff said at the end of the beginning of this. Obviously copy that chat box if you would. You got the 3 little dots there at the bottom, so everybody can get everybody's contact info. And we appreciate everybody tuning in.
Yeah.
All
John,
right.
Anton, anybody have anything else to add? Otherwise, I'll call it a wrap.
Sounds good. Thanks.
All right.
Right.
Thanks, everybody. Be safe.
We'll leave this room open so people can just talk if y'all want to.
Thank you all. Thank you all.
Thank you. Bye-bye.
Thanks.
Thank you. Bye.
Bye-bye.
In the fridge, always.